Hello, everyone. Thank you for attending this Zoom class this morning. Good morning. This is Si Wing Yi, and thank you for attending this Sierra College Community Education class. And today is what's Saturday, June 26th. How time flies. Anyway, as I said, this class is the topic is profit from this historic post-pandemic real estate boom out of state, buying out of state properties. All right, so we all know why, but let me remind you once again. I mean, I live in Bay Area, San Ramon to be exact, for the past 30 something years. And prior to that, I was in active duty U.S. Army, 20 years, retired. I retired from the U.S. Army way back in 2002. Amazing. So this is a sort of my second and third career. I do this full-time, real estate investing, and been doing it for almost 20 years. So I'm a California licensed real estate broker. However, I do not sell local real estate, although I'm licensed to do so. I never sold any real estate in California, believe it or not, especially owner-occupied properties. But my forte is strictly out-of-state investing. This is my niche. This is my business model. And many of our California investors that I've taught over the years, similar to your venue, I mean, you know the challenge, right? So I want to show this a little bit. So look at this graph. The buyer couple on the left, it says, we really like to look at something a little higher priced. And the realtor said, okay, I can show you this house again tomorrow. You know what that means, right? Housing prices are rising on a daily basis, right? So I'm not going to cover too much about me. You can see I have, pretty vast academic background in addition to real estate investing years of experience. I have dealt with thousands of investors. I've helped hundreds and hundreds of California investors mainly, although I help just about everybody else in the country. Wherever they live does not matter. They can buy out-of-state turnkey properties wherever they live. Does not matter. They can live in Timbuktu, Africa, for all I care. They can still take advantage of this amazing booming rental real estate investment cash flow properties. All right, so here's the thing. Income property is the ideal investment. It is history's most powerful and proven multi-dimensional real estate asset class. Okay? Most powerful, most returns compared to any other asset class. I don't care, stocks or mutual funds or anything else, gold or bonds or whatever. Nothing is compared to real estate investing, income property that is. And the reason why are as follows. Ideal. The ideal means I stands for income, D stands for depreciation, E stands for equity growth, A stands for appreciation, and L stands for leverage. What does that mean is income means you're getting the rental income. You're getting, this is for the lack of a better term, this is a real estate scam, meaning you're having the renter, potentially your renter, gonna make you rich. Your tenant is going to make you rich. It's that simple. Okay. Later in the presentation, I will show you why there are more renters than ever in history is willing to rent your rental property. But anyway, income means passive income. It means positive cash flow, right? So you can retire off the passive income from your real estate portfolio, right? So then depreciation, right? Depreciation means you're getting some paper write-off, tax write-off, that will allow you to pay a lot less taxes on your income property than you would normally pay on any kind of income being earned. But there's more to a depreciation. There's many other tax benefits associated with real estate. Again, consult with your tax advisor to go over your situation. But again, it's amazing. So equity growth, and E stand for equity growth, and A stand for appreciation, which is kind of the same thing, right? I mean, really, you want to make money. How you make money in real estate is investing for the long term, allow for your house to appreciate, and a house on historical basis will appreciate over time. Always has been in the past, always will be in the future. So invest for the long term, and you will achieve significant equity growth and appreciation. And the lastly, leverage. L stand for leverage. Is that's another word for OPM. That means other people's money. You're leveraging your investments. You're not buying your investment property asset dollar for dollar. You're not buying at the full purchase price. You're not buying raw cash, although you could, but I recommend you not. I recommend you use the power of leverage. You can put in 20 cents on a dollar and allow the lender, allow the mortgage lender, the investment loan, the financing aspect of it to help with your purchase. Isn't that amazing? This is a truly winning the lottery. You know, each time you put in 20 cents to a dollar to buy income producing asset, which will grow over time, then I mean you can win. I mean, to me, it's a lottery. I mean, okay, not quick get rich scheme, but long term investment using leverage will increase your return, increase your capitalization rate, increase your cash on cash return, increase your total ROI, which is return on your investment. I'll cover more about that later on this presentation. Okay, so ideal is a history's most profitable, multi-dimensional, diversified asset class, which mainly consists of single-family homes. Although duplex, triplex, and fourplex is sort of a secondary to this income property definition. So the ideal world, as far as I'm concerned, buying a single-family home investment property and a little bit of duplex, triplex, and fourplex. That's it. That should be, you know, narrow scope that I'm going to cover. Although, you know, there are other type of properties you could pursue. So here's some additional investment philosophy that I have, which hopefully you will embrace as well as a student. Is here's a philosophy. One, buy real estate and wait, and not wait to buy real estate. Okay, it is, in a way, it is so simple, and yet it's so true. It has been proven historically. Too many people waiting, you know, procrastinating, paralyzed, whatever. They always, and they will never buy. They just wait forever, and then later on in their life, they're gonna wonder what happened. I you should have, could have, would have. Buy real estate and wait, not wait to buy real estate. Number two, you're not going to get rich on real estate. You do not own. Okay, you must take action and own that asset. Buy it, you know, now, so you could, you know, get all the benefits over time. And three, you can make money with real estate, or you can make excuses, but you cannot do both. I hear so many thousands and millions of excuses. Oh, it's too far. Oh, the grass is too green. Oh, the cash flow does not meet my criteria. Oh, the school district, you need to be you know, top-rated school district. Otherwise, I'm not going to buy. All those 1 trillion excuses, not going to do it. Okay. And number four, if you think real estate is expensive now, try to project 10 years from now. Okay, it's that simple. You know, real estate is priced for whatever it is right now based on, you know, buyer and seller coming together and create a price. Don't say, oh, it's too expensive, it's overvalued, it's overblown, it's too hyper. No, it is what it is, right? That's how it is. So people think it's okay. Well, let me give you an example. Number five, a house in Bay Area, San Francisco Bay Area, cost $100,000 in 1980. Now it is valued at $5 million. See, you know, this is that simple. You invest for the long term, and your house will compound. Compounding growth of an asset. It is that simple. Yeah, short term, yeah, you know there may be some correction associated with the market. We may even see some aspect of it, during this current booming market. But who knows? At the end of the day, imagine, right? If you guys, if anyone, not just the Bay Area, right, could be in Sacramento area, have you bought 30 years ago, your house would quadruple, 10 times, whatever, right? That's how it is because buy now, wait instead of wait to buy. All right, number six, the real estate has gone up in value over the past 100 years, or with one exception, which is the 2008 real estate crash, right? This is a all right. So, okay, my assumption is most of you are maybe are newbies because you have not purchased any rental properties at all so far, and you're curious, you're attending this class to see what's out there, right? And by me teaching at the Sierra College, it provides some legitimacy to the background of the instructor, right? Which is a good assumption to make because what you hear out there, out there, real world. I mean, who are you gonna trust, right? There's some people, scamming with investors, just like the scams are rampant. I mean, or in every industry there are scams, but you don't know who to trust, what system to buy, the real estate. So perhaps you are attending this Sierra College for the simple fact that, through the college you get some credibility with the college itself, with the instructor that they hire, so forth and so on. So that's good, right? It gives you some confidence level that, especially me as an instructor, I've been teaching at Sierra College off and on for the past 15 years, actually. I taught in Sierra College, same kind of real estate classes back in 2005, believe it or not, 2006. Then I took a break for a few years. Now I'm back for the past 2 years about in Sierra College. So I've been teaching. So, I have some very good, high quality students that come out of Sacramento market area through Sierra College teaching. So I thank that school for the trust in me and providing the value. The value you're going to get for the next 2 hours are really very different than the value you get, by Googling real estate investing or you go to YouTube video channels, right? Because all the YouTube video channels on real estate, I mean, it's so scary. Some of this potentially overhyped, inaccurate information you may get from out there, right? So be careful out there. There's a lot of, although there are some legitimate companies out there that claim to help you, but there are many other shysters out there, right? That can potentially scam your money, right? Especially when you buy out of state. You know how scary and just paralyzing to buy out of state, right? So I hear you. I know understand your challenges, what have you, but I have to assume is most of you are. Here's the investor profile that I may be wrong, but the kind of students that attend my classes, not only Sierra College, I teach at other schools in the Bay Area also for many, many years. So you guys are working full time, right? Whether you are in a medical profession, nurse, doctor, or whether you are a regular government employee in Sacramento, or you own your business, or you're W-2, you're engineer, you're doing well, maybe yeah, you're working full time and just slaving away. I mean, going through the rat race. You may have invested in your IRAs or mutual funds or stock market a little bit, and you see what's going on out there in the realistic world right now. A tremendous appreciation, skyrocketing housing prices. Then you said to yourself, "Hey, why not join this? Why not be a part of the wealth building scenario, right? So why not diversify, right? Why not diversify above and beyond the mutual funds that I have or the stock market investment you have, and venture into real estate to see whether real estate can be part of my financial planning, right? So those are questions you ask yourself. Your motivation. I don't know your motivation for attending this class and beyond this class. So if you are committed, if you're motivated, you have a lot of courage, if you can overcome fear, you can become a very successful as to invest out of state. Clearly, let me give you another thing. Okay, like I said, I live in the Bay Area, right? I mean, I know, every city in Bay Area is different, but the median price of a house in San Francisco is approaching $2 million right now. Okay, and the median price of a home in Palo Alto, in the peninsula, is like more than 2 million. Median price, and the median price of a home in San Jose is approaching 1.4 million, maybe 1.5. This is mind-boggling. And the median price home in the East Bay, in Fremont, and Hayward, and a Tri-Valley, where I live, San Ramon, Danville, and Pleasanton, and whatever, is like 1.2 million. This is crazy. And you in Central Valley, look, I go to Sacramento a lot, like once every other month, right? So we have some connections in Sacramento. So I know your area, Roseville. I know the area very, very well. Okay, so I mean, even the median price, because of the rampant appreciation, the median price in Roseville is probably like 450, 500,000, and in the surrounding areas like in Lincoln and Rockland and whatever, is already like 400, 450K. So skyrocketing prices, amazing. So I don't need to tell you, you're right. You cannot buy a rental property in your own backyard, if you will, right? Let me give you some number crunching. Let's say you're making one person want to buy a property in a Sacramento area, like like I said, $450,000 median price. You need a rent. You need a rent, somebody renting your house for like $3,000 or $3,500 in order for you to make a good return. Or you can get a renter going to pay you $3,500 to rent your $450,000 investment property in Sacramento. Let me cut to the chase. No, right? Assuming that's the benchmark is you can do financing. You can pay 20 to 25% down financing on a home. So if you factor in all your monthly debt, mortgage, taxes, insurance, property management fee, if applicable, whatever, you need the 1% rule, which I will cover later on this presentation. You need to have a 1% rule. 1% multiplied by 450,000. You need somebody to pay you a rent of $4,500 a month in order for you to cash flow with 25% down payment. No one, the market on this price, you're lucky someone can pay you $2,000 per month. Am I right? Right. If you're buying a house for $450,000 in Sacramento, and the rent is tapped out at $2,000, maybe $2,200, and you put 25% down payment, you know what's going to be your monthly negative cash flow, like $700 to $800, right? So that's the reason why you are motivated to attend this class, to see clearly buying rental property in California. It doesn't matter if it's Sacramento or Reno or Lake Tahoe, the numbers does not work, right? The number does not work unless you pay all cash. But who wants to pay all cash on $500,000 property, right? You can put all your eggs in one basket. Why put all cash if you have $500 of cash to buy a $500,000 property in Sacramento? You make cash flow, of course, as you have no mortgage. But why? Why put all eggs in one basket when you can buy 5 or 10 properties out of state with the same amount of cash you have, using financing? Pick the right market, which I will show you later on this presentation, and achieve cash flow, and you can potentially retire in 5 years with this money, or even less, right? Okay, do I rest my case? Say yes, put a thumbs up. All right, let's continue. All right, so some of you may or may not own a principal home here in the Bay Area or in Sacramento, whatever, it does not matter. If you're motivated to buy a rental property, if you have the money, if you have the down payment, you have the credit and all that, you have a good job, good W-2 income, whatever, you are positioned to take advantage of this booming market. All right, so, okay, does that make sense? So you can do it regardless of your background, as long as you have fair amount of education, fairly common sense, intelligence, and do some education, like you're doing today. You know, education is a lifetime journey. Okay, you could never learn enough. So the best type of uh, thing to do is to take action by real estate and learn by doing, not learn by academics. All right. Okay. Whew. Does it make sense? That I covered the whole gamut of the motivation and the background and all that stuff. So whether you have whether you're a newbie, whether you are a savvy investor, you can take action to buy investments out of state in a very simple way. I will show you. So let me see what else I have to say. But having said that, as a newbie, you know, I have to be very realistic. You are facing some big challenges, right? Huge challenges. But hey, you have to overcome that, right? Each one of you look at yourself in the mirror, right? And just, you know, ask yourself, you know, do I have what it take? Am I motivated? Am I committed to the process? Do I have a positive attitude? You know, am I committed to this? You know, can I overcome fear? All those factors, only you know your motivation behind what you want to do. All right. So, all right. Okay, let's go on. So post-pandemic real estate investing. Wow, what can I say? You know what triggered everything? You know, I'm sure unless you've been living under a rock, there are three things that's going on since the pandemic began in the early part of last year, 2020. One is there has been, for the past 10 years, ever since the last market crash in 2008, that has been the population growth have exceeded the supply of homes. Even the pandemic, there has been a lack of supply of homes already. The pandemic itself only exacerbated the whole problem. So what we see right now is what triggered everything is the millennials. The millennials are entering the home buying stage of their life right now. And also the supply of homes is extremely limited, the lowest amount of record inventory nationwide ever in the history of America. Plus, because the government want to stabilize the economy during the pandemic, COVID-19 last year, the government and the Fed decided to lower the interest rate. That lowering of the historical lowest interest rate environment in history has absolutely triggered this massive accelerating of home prices ever in history. Okay, so that's what's happening. Low supply, high demand, and then especially last year, many potential sellers of homes are not willing to sell because they don't want buyers to walk inside their house due to the infections, scare, the COVID-19 stuff. So all those things combined are creating a very unique, challenging real estate market. Agree with me? Okay, I just covered the whole gamut, all right, of the very unique, challenging environment. All right, so having said that, I believe the best asset class is single family homes, residential investing. You know, I'm not going to waste time to talk about commercial, retail apartments, flipping, short-term rental syndications, whatever. Those are, to me, are just a secondary ways of buying real estate. The best, easiest way, the most efficient way, the most profitable way is to focus on this narrow business model that you have, this narrow niche. The niche is buying single family homes, mainly as an investment, right? That's a main core foundation plan that most investors such as yourself should partake in. Do I make sense? Do you agree? I don't know. Okay, you can talk about it during the Q&A stage. So, all right, let me see what else. So again, what triggered the boom, as I already said, right? In fact, I went ahead of myself. Oh, and then of course, the builders for years have not built enough homes to accommodate the population growth, and even as we speak right now, the builders are not building. The supply and demand imbalance is so off the chart, so contrarian, so contradicting. It just will continue to create this housing challenge scenario moving forward. I'll discuss more about that. All right, so as we know, working from home is the wave of the future. Not 100%, but it's like hybrid, working model. Workers are no longer needed to live close to their work. So people are migrating into the suburbs. People want to have more space. People want to have a backyard. People want to have social distancing. So everybody's moving to the suburbs, right? We know that. Okay, we've been hearing all over the news for the past 2 years, right? Migration from the in a densely populated urban areas such as San Francisco Bay Area, so Southern California Metro, Chicago, New York City, Northeast. A lot of people are migrating into affordable markets. Okay, we're going to talk about that, right? And you can see some of the areas that they're going. So, all right. So let me see what else. I'm not going to talk about the government program, the forbearance, the foreclosure situation. It'll come into play later this year. But suffice to say, there's not going to be that many foreclosures, believe it or not. But I can't spend too much time on that. So let's focus on what's going on. See, I mean, you as an investor, you have to ask yourself, where in a country is the best area to buy investment property out of state, right? Okay, that's why you pay the big bucks for this next 2.5 hours to learn. Okay. Okay, I digress. All right, so we're not going to have another crash, right? I can almost assure you that. I mean, 2020, 2021, and beyond, there will be no crash. Regardless of some YouTube entertainers or try to tell you otherwise. They are. Anyway, I mean, because right now only highly qualified people are buying properties with all cash or with very good credit that are financing with a very good loan. The lenders have learned their mistake back in the 2008 crash. So yeah, you're not going to see a crash or even a correction or even a bubble. You can see some minor correction real estate wide in the next few years, and I'll tell you more about it. So, all right. So as you can see on this chart, the U-Haul migration pattern, right? The red color means that people moving out of the area, which is out migration, and the green color, as you can see, are in the migration market. So a lot of people from all over the country are moving into the green dot, right? As you can see, most of the people are moving to south and southeast. You see Texas, 1, 2, 3, 4, 5 dots. You see Florida, 1, 2, 3, 4, 4 dots. You see North Carolina and South Carolina and Georgia and Tennessee, right? And also in the west area, you see, Pacific Northwest, Portland, maybe Seattle, and then Boise, Idaho also has, appreciated amazingly right there. And then Utah, right? Utah is doing well. Arizona, Phoenix area is doing well. Las Vegas is doing well. And for the most part, my personal favorite are Texas and Florida. And then, of course, right close behind is North Carolina. And we'll discuss more about that, all right? So you see that? You see the whole big picture? So this migration pattern will continue for years to come, okay, based on preponderance of economic and real estate data that I have researched in my real estate career. So this is what I do full time, and I follow the trends, I follow the markets. So 9 times out of 10, I'm right. Okay, because I help many investors, hundreds and hundreds over the years to buy in the cash flow markets all over the country. But right now, the best area clearly is Florida and Texas and North Carolina and even Alabama, and some Midwest markets also should be part of your portfolio acquisition strategy. And I will discuss more about that, right? Okay, again, this map also just to validate what I just showed, the future of growth. And if you want to make money in real estate, you follow the trend, you follow the population growth, you follow the job growth, and they are happening in South and Southeast. Okay, I'm gonna, this may sound like a broken record throughout this presentation, but some of you are going to be asking, wow, you know, Arizona is doing very well, very well. Arizona is so close to California. A lot of people from California moving to Arizona and Phoenix is exploding in growth, in appreciation, housing, whatever. Same thing with Nevada. Same thing with Utah. Same thing with Idaho. Whatever. I get it. I understand. But my answer to this is be careful, because those markets, although it's getting 20, 30, 40% appreciation in the past few years, but those housing prices are too high relative to the rent that you're going to collect. So with that said, those markets in the Midwest, in the West, with the exception of Las Vegas, surprisingly, you can still buy cash flow properties. Maybe I'll cover more about that. All right. So I like to tempt your excitement as a real estate investor. Do not buy in Boise, Idaho, Washington State, Oregon, Nevada. No, Las Vegas is okay. You do not buy in Utah. Do not buy in Arizona. Just because those areas are exploding growth, it does not mean you should buy there, because it's too expensive relative to the rent. So the returns, the capitalization rate, etc., the number does not make sense. You buy in an affordable market where the price of the property match the rent you're gonna collect. At the end of the day, you crunch the numbers. If you put 20 to 25% down payment, you will achieve positive cash flow. And that is happening in the South and Southeast and in the Midwest, right? I will discuss Midwest and South and Southeast should be your portfolio acquisition strategy, short-term and long-term. Again, I will go over that later on in this presentation. I'll give you more details. Okay, I will dive deep into that. So for right now, just follow my presentation. All right, so this slide, I'm not going to talk too much about it, other than there are still many people who cannot buy. They are the renters. This is the renter nation of the future. There will be more renters and tenants than ever before in history. And on this graph right here, the top technology regions. Now, another criteria you should evaluate when you buy in a particular market is look at the technological growth. So I know you look at the whole economy wise. You want to buy in a location where have more than 100,000 people, or in the suburbs of a larger city perhaps, and they have a diversified economy, such as manufacturing, industrial, banking, government, military, technology. You want a diversified economy. So in case of a downturn, that market is not going to take a hit, right? That market is not depending on one specific industry. You know what I mean? But on top of these basic metrics I just discussed, if a particular region or a metro that have some kind of technology hub, some unique over-the-top technological growth above and beyond the basic economic metrics, then it'll make it even better for you to focus on that particular area. So with that said, I mean, I'm giving you a sort of a top 10 tech hub, if you will, where you can potentially pull the trigger in. So now, in fact, I'm gonna give you a sort of a quiz. All right, okay, here we go. what does this mean? Following names mean. Number one, Silicon Valley. Number two, Silicon Hills. Number three, Florida high-tech corridor. Number four, Rocket City. Okay, number five, Silicon Forest. Number six, Silicon Beach. Number seven, Silicon Prairie. Number eight, Research Triangle Park. Number nine, Dulles Tech Corridor. Number 10, Brain Power Triangle. So you would agree that these top 10 tech hub are very enticing, right? So if you can buy at an affordable price, which with the rent match the price of the property you want to buy, and you can cash flow or have a positive monthly cash flow as a result, with 20 and 25% down payment, you will want to pull the trigger. But on the other hand, some high-tech hub with the housing prices so high and the rent is not even barely going to cover any part of your debt obligations, then forget it, right? So let me tell you which one I'm going to eliminate as we go down this list, all right? So Silicon Valley, obviously, with a $1 million single-family home, you're going to expect somebody to pay you $8,000 to $10,000 monthly rent? No. So cross Silicon Valley out of your whatever, okay? So Silicon Hills. Where is Silicon Hills? Do you know? Silicon Hills is Austin, Texas. Okay. Yes. To Austin, Texas, maybe. Okay, I'll cover more about that. The price is getting too outrageous in Austin, given what's happening in the past 18 months. And number three, Florida high-tech corridor. Well, you didn't know Florida have some kind of high-tech hub going on. Well, it's the Space Coast, spaceships, technology, all those things that's happening. It's a small little high-tech hub, which is located in Palm Bay. Palm Bay, which is the 1 hour east of Orlando. You have Cape Canaveral, Kennedy Space Center. You have the commercial industry using the Space Coast with Jeff Bezos and Richard Branson and Elon Musk. They are involved in space, and that's what's happening in Palm Bay, Florida. Okay, small little hub, but it's under the radar for a lot of people, but not to you guys, right? Rocket City. I bet you have no idea what I'm talking about, Rocket City. Rocket City, Huntsville, Alabama, home of the also space technology, government, rocket, all those kind of things, and military and space force are located in Huntsville, Alabama. Rocket, AKA Rocket City. Up and coming, small little tech hub, which is under the radar for many potential mainstream people, but not to me and not to you either. Silicon Forest. Where is Silicon Forest? Oh yeah, that's Seattle, Washington. That's right. That's Seattle, Silicon Forest. Way too expensive. Forget it. The returns, the numbers does not work. Forget it. Too high. The price is too high. Silicon Beach. Well, Southern California, obviously. Southern California is just as bad as the Bay Area. $1 million homes, right? Is not a rental market for anybody, including yourself. Silicon Prairie, give up. Is in Dallas, Fort Worth Metroplex. Silicon Prairie, not bad, but the prices are starting to creep up, and the cash flow is getting a lot less. Number 8, some of you know, Research Triangle Park. That is in Raleigh, Durham, Chapel Hill corridor. So very high tech, booming market in North Carolina, Raleigh, North Carolina. Research Triangle Park. Apple is going to building a main campus there with 3,000 engineers making 100K. So they are moving there right now. So it's creating some tremendous housing price appreciation as we speak. All right, and so definitely for the remaining of this year, there are some opportunities for cash flow in Raleigh, North Carolina, but after that, no more cash flow because the prices will skyrocket. All right, Dulles Tech Corridor, Dulles International Airport. That's in Northern Virginia, which is the part of the Washington D.C., Northern Virginia high-tech mecca. Government, obviously you have the government, you have the U.S. Capitol, you have Northern Virginia, but housing prices are very expensive, 800, 900K median price, not for investors, right? Investors, the rent is not going to cover the massive high price. And number 10, brain power triangle. That's Boston, Massachusetts, that's Harvard, that's MIT, right? Again, housing prices are very expensive and the numbers does not work. Okay, so there you go. All right, so let me see what else. Obviously, that multiple offers everywhere, all over the country, right? Multiple offers. Some markets, like there are like 100 offers on per house, which is absolutely mind-boggling. But normally right now, I don't know, depending on what area, typically you'll get 10, 15, 20 offers per property. And that is still pretty amazing, pretty sickening, as a matter of fact. All right, so let me see what else. Yep, all right, let's move forward. I mean, the old world of real estate investing is over. Today's world is changing at an exponential speed. In today's age of technology and information, as an investor, you need to adapt to change. Otherwise, you'll be history. So real estate investing is no different. All right, what else? The future of real estate investing is live where you want to live, invest where the numbers make sense. So live where you want to live. Continue to live in Roseville or Sacramento area, wherever you live right now. You're watching my Zoom. That's fine and dandy, but you have to go out of state to buy in an affordable market, in a good neighborhood, where you can achieve cash flow, whether hopefully your rent, the tenant's rent will cover your debt obligations, and ultimately you can achieve break-even cash flow or monthly positive cash flow. And those markets are, as I told you, in the South and Southeast and in the Midwest. All right, so given these days that people can use their internet and computer, you can do most of your research through this medium, right? Modem. So the pandemic has really drastically changed our world, the way we live, and real estate investing is no different. All right. Having said that, so as a real estate investor or wannabe investor, right? Given how busy you are with your full-time work, dealing with the rat race, all those things, and dealing with children and family obligations and this and that, I challenge you not to be a full-time investor. You can become a part-time investor. What I mean by part-time investor? I mean, you could invest passively. Still, you can buy 1 or 10 or 20 or 30 rental properties out of state, and you do not even need to spend more than 2 or 3 hours per month in quote unquote managing your properties. Did you hear what I just said? Am I crazy? Is Mr. Yi crazy? Is he cuckoo? Is he crazy? One over the cuckoo's nest? Jack Nicholson. No, I'm not cuckoo. This is a reality world. If you use the right system, the right platform, the right concept to buy out-of-state investment properties, you can keep your full-time job and do this massive portfolio acquisition strategy part-time passively, where I say it again, all you need maybe 1 to 2 hours per month in managing your multiple investment portfolio houses in out of state. All right, so I'm gonna ask you to have an open mind, all right? That's all you need to do. Just have an open mind to hear what I'm trying to say, tell you. I will explain further, okay? All right, so one of the things you need to incorporate in your life is these three concepts, which I have created this myself back in the more than 15 years ago. When I started investing in 2004 out of state, several years later, I thought I created this three acronym. I should copyright this, but who cares? But I'm not. Okay. The three acronyms are very, very important. You need to embrace this. You need to buy into this concept. Otherwise, you're not going to make it as an out-of-state investor in California or wherever. OPM, OPK, and OPL. OPM is other people's money. You leverage your debt and money. That's why, for those of you that have good credit, having good credit is a major, major attribute. And do not take it for granted, because you have the ability to get financing other people's money, because you are allowing the lenders to trust you because of your good credit to borrow money to leverage your investment in a form of a loan, investment loan. Isn't that crazy? OPM. And the interest rate right now is still at a historical record, low rate. Mind-boggling. Do you remember back in the 1980s when the interest rate were as high as 18%? And people back then are still buying properties, even with the 18% rate. Now you're getting a owner-occupied like 3.2 rate, which is mind-boggling. As an investor, your loan is going to be around 3.5, 3.6, 3.7 interest rate. And they're still amazingly good and record low interest rate, historic. All right, so OPK, other people's knowledge. Look, as an investor, you don't need to get overeducated, okay? In fact, some of you can pull the trigger right after this presentation, actually, right? For whatever the reason. And many of you will thinking, oh, I need more knowledge. I need more education. Yeah, education is everywhere. I mean, you can go look at the YouTube video. You can attend real estate investment club, live classes, free club meetings or whatever, all over California. Or you could, sign up for some kind of a website and you get some free education everywhere, right? So with the power of the internet and your computer, you can Google, you can do YouTube videos, you will find all kinds of real estate topics for free, actually, right? So lack of knowledge is not a detriment to you, right? So yes, learn as much as you can. Real estate learning, just like any kind of learning, is a lifetime endeavor. The best way to learn is take action. You learn by doing, not, you know what I mean? At some point in time, you need to take action. All this, I have seen too many investors, even to this day, our members in our database, that's been, logging into our videos on a weekly basis, keep on learning for the past 15 years. At the end of the day, most of those people still have not purchased a property. Very, very sad. So OPK, other people's knowledge, you just learn the basic. You need to surround yourself with a team of financial professionals that a trusted team, that is, that you should work with. Your real estate consultant, your financial coach, mentor, consultant, guidance financial counselor, whatever, and then you need to hire a tax advisor, a CPA, certified public accountant, and an attorney, you know, and whatever, right? So you leverage your knowledge to other people to help you achieve your financial freedom. Okay, OPK, other people's knowledge, and finally, OPL, other people's labor. No more TNT. No, that's not a TV channel. TNT is tenants and toilets. Okay, you are not gonna get down and dirty and change the doorknob or change the bathroom or rehab your property on your own, like you see on those TV, HGTV, House Hunters, whatever, and all those rehab shows you see on TV. I see it all the time over the past 15 years, where the owner, prospective buyer, are getting down and dirty, knocking down walls. I would not do such thing, and neither should you, especially when you buy out of state. So you will apply that concept of OPL, other people's labor. Let them do all the dirty work. In fact, not only I never do any kind of rehab on any of my houses, I can hardly change the doorknob of a door. You can ask my wife. Okay, she always ridiculed me for, see, you know nothing about rehabbing a property. Okay, so what are you trying to tell me? Do I care? When I buy investment property, I look at the numbers. I invest passively. I let other people's do all my work. I let contractor, property managers, rehabber do all my work out of state. I'm not going to get down and dirty. Okay, I'm not going to fix the toilet. Not that I know how. Right? So OPL, let other people do all the work for you. The house you buy, the rental property you buy, believe it or not, you will probably 9 times out of 10, you're not going to physically even see it, ever. Sounds scary? No, a lot of people have done it before. So you will never see the tenant. You will never talk to the tenant. I mean, you could if you want to, but the property manager is your eyes and ears. They will do all the communicating for you. They will send you a statement. They have a, once the property management are in place, you have a login portal. You have a software portal. You can click and you will see whatever transpired, what the property manager has done, the rehab that was done, the cost you have to pay. Everything is real time online. Your online software portal. That is how you manage your multiple out-of-state properties. Because property managers, they're getting better now, not because they're getting better really, because there are so many tenants per house, it makes their job easier. So that's how you manage your property, by logging to your online portal, on each of your properties. It is that simple, is it not? OPL, OPM, and OPK. All right, I digress. So the next step is, how are you going to design and build your real estate portfolio? Now, here's a challenge, right? I mean, buying your first property is the biggest challenge, and most people simply cannot do it for the simple fact I just explained earlier at the beginning, where you have 1 trillion excuses to not to buy. Okay, I get that. But for the few of you that have amazing courage and perseverance and discipline and positive attitude and commitment, all those, psychological skill set that you need to have as an investor, you can pull the trigger and you could become successful. Either you can buy one property at a time every 3 months, because it'll take about 3 months to begin open up the escrow or closing the escrow and getting the property manager. You can buy one property at a time consistently for however years you need to buy consistently based on your available financial resources. Or some of our investors are so ambitious, they are so motivated, they have the ability and they have And to this day, to right now, as we speak, some of our investors are buying 3 or 4 properties at a time, all with mortgages. They're doing multiple closings because they have a lot of confidence, right? They are very disciplined, very motivated. They have their own reasons why they want to do. So I'm not saying, but like I said, everybody's different. Everybody have a different personality, different background, different history, different skill sets, different amount of fear or lack of, and what have you. But that's what I've seen. Most people will never do anything. 99% of the potential newbie investors out there, it doesn't necessarily apply to my network of members, but 99% of people out there all over the country, all over the world, really want to buy real estate. They know it works. They know it's a powerful way to build wealth, but like I said, for a number of excuses, they can't do it. They won't do it, and that's the way it is. That's human nature, psychological profile. So, having said that, for those of you that want to take action, here are the following action you could take. Buy with leverage, right? Maybe not 15% down. I think the lending program does not allow any more for the 15% down payment, but Fannie Mae lending guideline allow you to buy up to 10 mortgages per individual. All right, so you can single family home, you can buy with 20 to 25% down payment financing. On a duplex to a fourplex, your minimum down payment is 25% down. So, look at your financial profile, look at how much money you can allocate to buy investment properties, right? And do the math. And something, the second scenario, which I don't have time to talk about, which is an amazingly powerful strategy. Once again, most mainstream investors have no knowledge whatsoever that you can buy rental properties in the name of your IRA. Yes, you can use your retirement account to buy investment real estate in the name of the IRA. So powerful strategy. Unfortunately, I don't have any time to talk about it, but I do have some videos. As a matter of fact, look, now that I have your email, I'm just going to do one thing. Obviously, I'm not gonna reach out to you. Of course, I don't have your phone number, so I'm not gonna call you anyway, even if I have your phone number. So I'm gonna ask you I'm gonna put your email into our newsletter database with my organization, so you will receive free weekly newsletters on everything on real estate, right? So you can achieve free education to be part of our so-called membership, free membership. That's all. Okay, no one gonna solicitate you by email. I mean, yeah, email, you get newsletters and videos from us. That's it, right? If you wish to pursue further, then you will reach out to us, and we will consult with you. So having said that, so there's more education beyond this presentation through the newsletter that I'm gonna I have your email already. So unless you decide, you tell me you don't want your email to be on my database, and I will respectfully honor your request if that's what you want. All right, so let me see what else. And the third concept is how to design and build your real estate portfolio is using a turnkey, remote, sight unseen, sort of passive investing approach. Everything is already done for you. So that's one platform that you could apply. So another thing is there's no U.S. housing market. Every neighborhood, every market, every city is different, right? So keep that in mind. Okay, all right. So lending, again, low inventory, historical low interest rate, rising pent-up demand equals red hot real estate market. Interest rate right now is at mid threes for investment loans, and you can get up to 10 mortgages per individual. So if you and your spouse are both working full-time, have W-2 income, have good credit, and you have lots of money, you can buy you can obtain 10 mortgages, Fannie Mae lending guideline, top of the line mortgages under one name, under your name. Then after the 10 mortgage has expired, then the other spouse can use his or her name to obtain another 10 properties with 10 mortgages, right? So total of 20. So if you buy a single family home rental or a duplex or a triplex or fourplex, 1 to 4 unit, is still considered one loan for the purpose of the 10 mortgage maximum limitation Fannie Mae lending guidelines per person. Am I clear? All right. So let's go on to recap. If you need to go beyond 10 mortgages, there are some secondary loans available for you with a higher interest rate, higher down payment, maybe 30% down payment. Not so bad, right? And they are secondary loans. They are like commercial loans even, but it doesn't have to be, right? So who knows? Very few of you are going into the 10 to 20 mortgage situation. But if you are venturing into that arena, then of course there are some alternative investment loan strategies available for you, so you can continue to buy the properties based on your goals and objectives. Does that make sense? Okay. All right, let me see what time is it. All right, right now we have done this for 1 hour. So, all right, we have done this for 1 hour. So we have 1 more hour to go on this pure presentation. Then we can, like I said, at around 11:45 a.m., 15 minutes left. We can do some Q&A through chat or through live interaction. I see your face, you see me. We can talk by audio. So therefore, we can have some really good relationship dynamics. I can see who you are. You can see who am I, although you're seeing who am I right now. All right. So how to design and your portfolio. Secondarily, you should buy for geographic diversification. Do not put all your eggs in one basket. You know what I mean? Do not buy 10 or 15 properties in one city, one neighborhood, or in one market. Because just like stocks and bonds, you need to diversify your portfolio. So in case, one area does not do well, you can offset that with another good performing real estate in another location, right? That's a smart way of doing things. So, you buy for, good cash flow, high cash and cash return, high return on your investment, high rent to price ratio, etc. I will dive deeper into the calculation. What I mean by that momentarily, just follow me. And another investment philosophy you need to have is, you need to buy and hold long term. Why sell at a wrong time? If you sell any one of your rental property, you know what you're doing? You can kill the goose that laid the golden egg. The one goose that you have, one rental property, is laying a lot of golden eggs. What are the golden eggs? The golden eggs are the passive income, the cash flow, the equity growth that you have, right? Those are your golden eggs. You're laying multiple streams of income and equity from your house long term. Why kill the goose? Why sell the house? I know I'm not saying never to sell. Everybody have some personal reasons to sell. Everybody have economic reasons to sell. In the near future or down the road, we don't know. But everybody's situation is different. But you need to consult with your team of financial advisors to ascertain the consequences, tax-wise or estate planning-wise. What are the consequences of selling a property? How much taxes you have to pay? What are the what the implications of your retirement goals associated with that. So, make an informed decision, leverage your team, show common sense, do the analysis, don't, use too much emotions, don't rely solely entire on your emotions to make a decision because it'll come back to haunt you. All right. All right. These four formulas will make or break your investing career. Okay, I'm not going to dive too deep into the pure mathematics. I know a lot of people have a lot of challenges. Most Americans have problem with pure mathematics. We're bad in math, right? Okay. But I'm not asking you to be a math genius or whatever. I'm not asking you to be a expert in calculus or trigonometry or whatever. I myself will not even close to being a math genius, contrary to my culture. but what I'm good at is look at the conceptually, look at the math in a very conceptual way, and that's all you need, right? I mean, look at the high level, look at the basic concept of money, right? The formulas, these simple formulas I'm giving you. I mean, let's face it, you don't, you know, it's pretty common sense. Anybody can grasp this, I hope. Okay, so the first and foremost is the 1% rule. I already discussed this, so up until now, earlier, is rent to value ratio. I know 1% is a benchmark. Given what's going on right now in this market, a lot of us are not getting a 1% rule unless you buy in a Midwest market area. But a little bit less than 1% is fine, like 0.07 of 1% will suffice. We'll discuss more about that. So basically, 1% rule means rent to value ratio means if you buy $100,000 property, multiply by 1%, then equals what? $1,000. $1,000 should be your monthly gross rent. That's it. If you meet this basic 1% rule, you're going to cash flow, right? You don't even have to look at the monthly mortgage or taxes or insurance or property management fee or 5% vacancy factor or 5% maintenance factor. The fact of the matter is, if you meet the 1% rule, you will have a positive return on your investment. You will have positive monthly or annual net cash flow. 1% rule could be 0.07% as well, right? I'll show you the example momentarily in a subsequent slide. All right, the second formula you must know is capitalization rate. Again, I'm not going to dwell too much on it because I don't want to, your brains are probably kind of fried right now because I'm asking you to digest so much information in such a short period of time on this Zoom webinar. But hey, the fact of the matter is you're going to get a recording of this video so you can, watch this more than once later on. So you can, sometimes you do it, you keep on repeating the process, you will get it eventually, right? So capitalization rate is the net operating income divided by the purchase price. Net operating income, you exclude the mortgage. Net operating income means you take the gross rent, you minus all the debt obligations, equal whatever the number, and divided by the purchase price. So a cap rate, the benchmark for cap rate is at least 5%. If your investment is at least 5% capitalization rate, then your property will achieve positive return. This means you will achieve break-even monthly cash flow or slight monthly positive cash flow if it is at least 5%. So if the capitalization cap rate is more than 5%, like 6, 7, 8%, this means you're gonna have a higher monthly positive cash flow. So that's good, right? So if your property is between 5 to 8% capitalization rate, this means this is a good investment. Okay, and third is cash on cash return. This is very important metrics if you're going to finance your purchase. When you finance your purchase, you put in less money down. You put in 20 to 25% down payment, and you're leveraging this on a mortgage debt. Therefore, you're going to have a higher return because for the reasons I just stated. So cash on cash returns technically means the annual cash flow divided by your down payment, your initial cash invested. It is that simple, right? So when you see a pro forma, when you see a cash flow analysis of a particular property, which I will show you momentarily, just plug the numbers from the so-called pro forma cash flow analysis on a particular property. You can easily calculate the capitalization rate, the cash on cash return on the financing, and finally, the total return on investment. The total return on investment is your investment, which is the annual gross equity income divided by the initial cash invested. All right, it sounds very technical, but total investment basically means that at the end of the first year, you just calculate your annual net cash flow, right? Plus your projection of appreciation rate for the first year. So you add these two up and divide it by your down payment. Then you will achieve your total ROI, total return on investment at the end of the first year. And that should be a very good number. All right, am I clear? I have done my best to explain this four formulas in layman's terms so any person can understand. Does that make sense? Whew, it's not easy, I'll be honest with you, it's not easy to explain this kind of things to you. But since I've been teaching for so long, I believe I have done my best to really speak your language. What I mean by that, your language means most of you are, or newbies, right? New in the investment market. You need to understand these basic concepts. You need to understand the benchmark. You need to understand the numerical formulas that give you a foundation of learning. Then above and beyond this number crunching, it's all about other aspects of analysis of your property, like economic trends and, market analysis. All those kind of things are additional above and beyond these numerical formulas, right? But you have to put everything together so eventually you can make an informed decision when it's time for you ready to buy a property. You can buy it with confidence, right? That's the key. Make an informed decision, do what is right for you based on your risk tolerance and your background, right? And then, and only then, you can you can take action to buy one property at a time or multiple properties at a time for that matter, right? So again, these numbers are another typical situation. So if you there are two type of property you should buy to create your portfolio. One, you can buy in the Midwest homes are a lot cheaper, right? And the rent is a lot higher, but those houses are older, 50 to 100 years old. Okay, don't be scared about that. People have been buying Midwest properties for years and years. Thousands and thousands of investors have done this for a very long time since I've been doing this. So this is part of their portfolio acquisition because it provides a lot of cash flow with very minimal purchase price. But there's pros and cons to everything, right? We'll cover that. And the other core portfolio building are buying newer homes in the higher price point in other part of the market, okay? And they're located in, mainly in Texas and Florida and North Carolina and a few other places, where the price of a single family home, new build, for example, is at least $150,000 to $250,000, and they rent a little bit less than 1%. But so there are, I will cover in more detail why you should combine these two market areas to create your portfolio. All right, so just look at the numbers on your own and then go proceed accordingly. So the question is where to buy, right? I mean, so again, I already gave you the big picture. You buy, could be 50-50 allocation, could be 40-60. It all depends, right, on your on each one of you, on your situation. But what about you buy for population migration? You buy where people are going, right? So if you want to buy in the Midwest for high cash flow properties, you have to subject yourself to cold weather, blue collar, working class demographics, older houses, older neighborhood, what have you, okay? And this is again, you're thinking, oh, is Mr. Yi, are you telling us that we can buy this kind of a old dilapidated home in a bad neighborhood? No, that's not what I'm saying. What I'm saying is, find yourself a good turnkey provider in this market. Midwest, what I mean by Midwest, Buffalo, New York, or Cleveland, Ohio, Toledo, Ohio, Dayton, Ohio, Indianapolis, Indiana, Chicago, suburbs, Chicago, Illinois, and Milwaukee, Wisconsin, St. Louis, Missouri, Memphis, Tennessee, Chattanooga, Tennessee, Mobile, Alabama, not Mobile, Alabama. This kind of Midwest market, or homes are built, 40, 50, 60 years ago. But, okay, and they are C-class, I call it, I provide a grade, right? A, B, C, and D class, right? So A class is the best neighborhood, but they're too pricey, so you may not want to buy in A class neighborhood. B to C class neighborhood is the best case scenario. So in the Midwest market, you're buying homes that are very old, but as long as they are turnkey, as long as they've been rehabbed properly, as long as you work with a very legitimate turnkey provider that will sell you this nice property in a good neighborhood, C-class neighborhood, blue-collar neighborhood, have a good renter, very little crime, it's available out there. So this kind of property, they have not appreciated that much compared to the other areas of the country. But again, the numbers are off the chart in terms of cash flow. So this should be an important part of your portfolio. Does it make sense? So this is a generic. I'm not going to pinpoint specific city, but I'm going to give you a generic number analysis why a Midwest market acquisition portfolio could be an important part of your financial freedom real estate goal. So this single family home, as you can see, well, maybe you cannot see that much, is a mere $47,500 single family home, and it rents for $850. Clearly, you will see that this property have a very good metrics, very high rent to value ratio, very high capitalization rate, cash on cash return, very high total return investment. You can finance, if you can finance a cheap property like this, right, leverage your debt, and the cash flow is so high that you can have a very high cash flow. In this case, the monthly net cash flow is $330, right? You put 20% down payment, and your total down payment is only like $12,500. Think about it. With financing on this $47,500 single family home in the Midwest area, I know this house could be 100 years old, could be 80 years old, but if you work with a very legitimate turnkey provider in that market that know how to pick the properties, rehab the property with their own money, you don't come up with the rehab money. The rehab money is already incorporated into the selling price, right? A good quality blue collar neighborhood, very, very, very stable rent, right? And you can collect $850 on this kind of price point. If you can get financing on this kind of property, and you can, yes, you can, depending on who you work with, the legitimacy of the turnkey provider. Some of you are asking, oh, how do you find this turnkey provider out there after you attend this webinar? Well, you could go out there, you can Google, you can use Google, you can go to YouTube video and Google turnkey provider, Indianapolis, Indiana, turnkey provider, Buffalo, Niagara Falls, whatever. And that's how you do your research, okay? But of course, in my organization, we have our own turnkey providers that we work with that has proven over time to be highly successful. So you can use whatever options you want. The choices is up to you. When you finish this presentation, it's up to you how to proceed next. Do you want to buy on your own? Really, you have three choices, my friend. When you're in this webinar, you do nothing. Well, if you do nothing, your life financially is not going to change all that much, if at all, right? Continue with the rat race, or you find your own, team. Or you can do it yourself, right? Yeah, you can do it yourself. You can go out of state and find your own house, fix your own house using your hands and knees, hammer the house yourself. You are your own contractor. You can self-manage your property out of state. Yes, theoretically you could. You can do everything yourself. You don't need to hire a team you don't have to apply the concept of OPM, OPK, or OPL. You can do everything yourself. Do I recommend that? No, obviously. I would not personally do it. Okay. I will only invest passively. You know why? Because I'd rather spend my time traveling, enjoy my life, hang around with my adult kids in the Bay Area and travel, cruising. That's my forte. That's my priorities. That's what I want to accomplish in life. I'm not going to spend my retirement years or otherwise hammer down the nail fixing the door of my house 4,000 miles away. No, I will use OPL, other people's labor, to do all the work for me while I relax. And when I sleep, I have mailbox money, automatic money coming into my checking account in terms of my passive income. Make money while you're sleeping. That is the idea. Okay? Make money when you're sleeping. Make money work hard for you, not work hard for your money. Is that clear? So this kind of property, if you do it right, if you find the right turnkey provider in a particular Midwest market, oh my goodness, you have won the lottery. You get me? This number is off the chart. A mere $12,500 down payment. Who cannot risk this money? Even the most fearful investor among you out there. Why not risk $12,500 a down payment to finance a single family home property for only $47,500, knowing that the renter is already living in this house? Yeah, when you close escrow, some of these houses is already rented at a tune of $850. When you crunch numbers with your small little mortgage leveraging, and you look at the numbers, you look at taxes, insurance, property management fee, at the end of the day, you can collect monthly of how much? $330 monthly net cash flow. Oh my goodness. You multiply by 12 months. At the end of the year, you will gain almost $4,000 of annual net cash flow. And on the amount of down payment you put in, only $12,500. Oh my goodness, your return, your capitalization rate on the upper right-hand corner is a whopping 13%. Your cash on cash return is a whopping 32%. Oh my goodness, is this unbelievable? Powerful, such a low risk investment with a high return. Come on, this is a no-brainer, isn't it? So why so many people are so scared to buy out of state? when money is paltry, the down payment risk is paltry in relationship to the benefit you can derive from this. Okay, so some of you are thinking, oh, there's a lot of maintenance repairs. Oh, there's a lot of cost. All the repair maintenance over time will make my cash flow disappear. Well, maybe, maybe not. Many of these property, again, if you buy from a right turnkey provider, they already, when you do the inspection, they have already, the roof has been replaced a couple of years ago. The water heater has been updated, replaced recently, or the electrical system has been upgraded. All the cosmetic repair, the floors, everything has been upgraded. It's turnkey. A house may be 50 to 100 years old, but the foundation, the bones still works, still rentable. Many blue collar renters would be more than happy to pay you $850 rent. And more often than not, this kind of renter, they are permanent lifetime renters, okay? They could, each renter could stay at your home for 3 to 5 years, sometimes even longer, okay? And so over time, yes, you're gonna have maintenance issues, few $100 here and there, but that's not gonna, make your cash flow disappear. Because as you can see on this cash flow sheet, we have even factored in a 5% vacancy factor, a 5% annual maintenance factor. This performance projection, as you see, have have projected all the scenarios, right? And the numbers still makes sense. So just because this property is located in an old neighborhood, do not believe that automatically that is a high crime area, that the tenant is bad, they can destroy your house, or this worst case scenario that whatever, no, all these are just misconception, okay? You'd be surprised. In many neighborhoods throughout the country, this blue collar neighborhood is very, very stable. The risk is not as great as what you perceive as such. Does that make sense? All right, so let me go on. Oh, wow. Okay, of course, these Midwest properties also have some really good duplex, triplex, and fourplex for only less than 150,000. Very, very, very high cash flow. I'm not gonna go through the numbers on these duplex, but do it on your own once you start the webinar replay, right? And then you will see the numbers for yourself. Analyze it. You will see the numbers off the chart. But in terms of appreciation, it's not going to appreciate as much as the other better markets. But even as we speak, a lot of these Midwest market have achieved double-digit appreciation in the past 18 months. Why? For the same reason I just told you. Low supply, high demand, low interest rate, everywhere in the country, all 400 metros. I have reason to believe that everywhere, it doesn't matter what location in 50 states right now, especially right now. I mean, because of this scenario, you're getting double-digit appreciation even on the Midwest. So that this is amazing. Just a unique market that I personally have never seen in all my years. Okay, so all right. So the next type of purchase scenario you should do is you can buy in a higher price point, higher prices, mainly in the South and Southwest, right? Florida, Texas, and North Carolina comes to mind. Although there are other secondary, tertiary market that you can also consider. So these are warmer market. There's affordable. The price is right. The price is right. The TV show, The Price is Right. Okay, they are located in Sun Belt, warm weather, good, strong diverse economic base, low cost of living, low taxes, good retirement, good new neighborhoods, A to B class neighborhood, and all those things. So Florida and Texas come to mind, and Raleigh, North Carolina, for example, Charlotte. New construction, well, a lot of people like new construction, but you pay a higher price point. So, but you still cash flow. So it may not meet the 1% rule, but slightly less, like 0.07 of 1%. In this case, this example in Florida, Southwest Florida. Actually, this pro forma was made like 1 year ago. This house is a real house, by the way, in La Belle, Florida, which is in Southwest Florida, Cape Coral area. But this house a year ago was selling for $175,000. As you can see right here, this very same house has increased to, I believe, around $230,000 in a mere 1 year's time. This house increased massively. So when I created this projection, at that time, less than 9 months ago, it was $175K. It was renting for $1,500. So at the end of the day, you put 25% down payment, I believe, no, 20% down payment. And then the net cash flow is $433, which is pretty amazing. But now with the skyrocketing housing price increases, all these new construction houses is gone through some very big challenge, and I will explain what I mean by that. So, very, very interesting. So this is a duplex, I believe. Oh, this is a duplex. I created this pro forma a year ago. This duplex located in Lehigh Acres for selling for $270,000. I believe this property is retail at $350,000, maybe even higher in a mere 9 months. Yep, skyrocketing housing prices is too bad. Many investors did not pull the trigger at the right time. They buying too late, but it's okay. That's the way it is. Okay, good cash flow. It's just I don't know. It's just. All right, here we go. Let me see. I want to keep track of time. Right now it's 10:42. We have at least 45 minutes left, okay? You got all, everybody doing well? Okay, so emerging market, like I said, here's the big picture. The big picture is the first tier market is Florida, Texas. Second tier market, North Carolina, Alabama, Georgia, Oklahoma, Louisiana, Mississippi. So these are affordable market, cash flow markets, but here are the Florida area. You buy in Central Florida, and then you buy in Southwest Florida. Those are the best market, according to my estimation. Okay, I'm not going to spend too much time on it. And Texas also has been booming massively for many years, especially recently. Well, so the big four in Texas: Austin, San Antonio, Dallas, and Houston. Austin have some amazing, just astronomical appreciation for many, many reasons. And the sub-markets in Austin, those are the sub-market you should consider, because inside Austin the prices have gone amazingly high in a very short period of time, which is very, very challenging. And then, so as I said earlier, you have three choices, right? You do nothing, right? Or you do something on your own, which is, as I told you, is very, very challenging. The chance of succeeding if you do it yourself is, to me, slim to none of success. But if you use the services of a turnkey provider, if you can find one, which is very hard, it's not easy, right? Then your chance of success as a risk investor the probability will skyrocket, right? So why turnkey provider? Because they know their market they've been working their specific neighborhood for several decades, right? They turnkey provider, they have connections in the local market. They have relationship with banks. They have relationship with the courthouse. They know where to buy, how to buy. They have a rehab team. They can buy the property at very, very deep discount. Well, I'm talking about the Midwest area, okay? Okay. But there are turnkey providers that are located in Florida and Texas, whereby they will concentrate on new construction, and you know, that's not much of a discount, but you can still cash flow in those markets. But yeah, turnkey provider, does all the work. They have their own rehab team, contract team, in-house property manager, whatever. They fix the houses with their own money, nothing out of your pocket. Isn't amazing, right? They find a tenant for you. Everything's turnkey, one-stop shop, very reputable. They have transparency. They communicate with the investors. Their property management are good. It's just what an amazing system. You as an out-of-state investor will virtually do nothing after you close escrow, but it is really that simple. So this is the way to go. This Turkey system will be around forever. If you can find them, they will help you invest for the long term. They will look out for your property for many years to come. They will find the tenant for you. They will replace the tenant. They will change the carpet, paint the walls. Upon change of tenant, you have to pay maybe $1,000 or more or less on a turnover, change of tenant. Potentially, they do all the work for you, as I said before, right? So, all right. So the next step for you is let's make a deal. Time to take action. The reality check for you is you leverage the knowledge of a team. You work your real estate business. You treat yourself as a business owner. You're not only a real estate investor. You are a real estate entrepreneur, right? Real estate is a contact sport, not a contract sport. It's all about building relationships. It'll behoove you to be very sociable, very build a relationship with your team. Just be proactive, communicate effectively. That's what it's all about, right? You gotta get along with people. The recap is it's a big challenge out there. Right now. So you're going to face a lot of competition for those homes out there. The supply of homes, or demands are exceeding the supply of homes. The pandemic situation, there'll be a lot of challenges moving ahead, but it's a good time to be a landlord. I don't even like to use the word landlord. You are a real estate entrepreneur. Okay, landlord means you will collect the rent, you will evict the tenant, you will, fix the property, you will manage the property. That's a definition of a landlord to me. That is a old definition, should not apply in the current investment world anymore. You are a real estate entrepreneur, right? You work hard. You see the value of using a property manager, right? OPL, other people's labor, right? So yeah, rent will do well. Right now, the rental market will be stronger than ever on a historical basis. Houses will continue to increase. Here are the reasons why. You should buy new builds in Florida and Texas, but there's a tremendous amount of challenge associated with the new build. I will go over that. I will dive deeper into that in the next few slides. But suffice to say, if you have the ability to buy new builds in good areas at a good price, so you have higher quality tenant, lower maintenance, good neighborhoods, but the price point is much higher these days. A single family home, typically around 220K to 300K. That's a new price point. That's a new benchmark. The pricing has, the prices have increased astronomically in the past 12 months for the reasons I just stated. A new build duplex costs between 400K to 450K, a fourplex 680K to 780K, but you can still get rent for 0.07% or 1%, so you still cash flow at 25% down payment. That's the, not much cash flow, but hey, you're going for cash flow and potential for high appreciation. That's what you look for, okay? You read this on its own, all these details about buying new construction, but it's not going to be easy. I would discuss that. Very, very challenging for investors nowadays. Things are getting. Let me give you an example of what's going on here. Something. This is just amazing. This fourplex is located in San Antonio, Texas. You know, one would think that you're not going to get too much appreciation on a multi-unit, but I beg to differ. This property was sold, as you can see, right? Maybe I think 4 years ago. At that time, it was a brand new fourplex in San Antonio. The purchase price was $460,000. Okay, this floor plan is very popular in San Antonio. Okay, follow me. Okay, let me show you the before and after. 4 years ago, like I said, 2017. Yeah, 2016, 2017. 4 years ago, 4.5 years ago. This fourplex, new build at that time, 460K, 3-bedroom, 2-bath townhouse. Each unit, as you can see, each unit is around 1,300 square foot. It's very rare to find each unit of a fourplex at a full 3-bedroom, 2-bath. Very, very rare. And the square footage is quite large, around 1,350 square foot. You know, it rents for like $1,250 per door. So the numbers are really off the chart, really good return. So let's fast forward to today. This same floor plan, same square footage, same design from the same builder. 4 years later, which is currently maybe even 3 months ago, is selling for $715. Just do the simple math, for God's sake. A mere 4 years ago, a multi-unit, which is historically speaking, doesn't appreciate as much as a single family home. Well, look at the difference. 4 years later, from 460 to 715K. No, wait, there's more. Sounds like an infomercial. Another simple fourplex in another neighborhood in San Antonio. Same floor plan, same square footage, is selling for $815,000 in San Antonio. If this house is sold for $815, and I don't know for sure, because this listing I obtained from Zillow a couple of months ago. Again, I make the argument that because of the multiple offer situation, it could be selling for higher than $815. I don't know. I will check later to find out what's the actual sales price. But at the end of the day, look at this. From 460 4 years ago to 815. I mean, this, in a mere 4 years, the price is almost double. In a mere 4 years on a fourplex. I have never seen this ever in any location in any part of the US. And this fourplex is located in the B plus neighborhood. B plus, B as in boy. Very good neighborhood. It rents very well, consistently. And so this is just one unique example that almost any kind of property in a good area, in an up and coming affordable market. I mean, the past performance is not an indication of future performance. We all know that, right? Nobody have a crystal ball, but I could see this property this floor plan can continue to increase in value for long term over time. So this is just one example of what can happen with any kind of property in a good area. As an investor, you need to target, find yourself a good turnkey provider that will put you in touch with this kind of properties. You can do well. Just think long term. Don't worry about some people say, crash, correction, bubble, whatever. Just ignore that. Because the rental is so strong, you're going to have a renter in there. I'll discuss more about that. But there's some challenges ahead. What are the challenges as an investor? Normally, there are quite a turnkey provider. You have inventory available for you in the past as an investor, because you don't have to go through the multiple listing service. You don't have to go do multiple bidding. You don't have to get involved in the bidding war that are subject to most people, to most buyers, right? Because as an investor, again, if you associate yourself with a turnkey provider, they will have inventory available for you for investment purposes only. Therefore, avoiding bidding war, right? If you want a property, you can have it. You have it. It's available for you as an investor if you connect yourself to a network. But now things have changed. I'm not saying it's impossible, but things are much more difficult now as an investor to buy out-of-state properties. And here one is the reason why. Okay. In this article, which I found, home buyers in the U.S. have found difficulties acquiring single-family homes as a result of the pandemic, because Wall Street, the hedge funds, pension funds, Wall Street are entering the real estate business because real estate is so lucrative. Even from a historical basis, is even more lucrative right now. So as a turnkey mom and pop investor that you are competing against, not only against other investors and owner-occupied buyers and whatever buyers out there, you're competing against Wall Street, hedge funds, pension funds, clearinghouses. They are entering the single-family home world. Single-family home is the multi-dimensional asset class, as I explained, the best type of real estate asset class to invest in now, in the future, and in the past. But you're getting more competition. Okay, we have lack of supply anyway to begin with. So Wall Street bankers are buying up all the single-family homes in the U.S. They're paying 20% of asking. Just bear in mind, there's more competition for you. But it is not impossible. There are some, you can still get it. You can still find the property that you want, but it'll be a lot more difficult. You have to really work hard. Low interest rate, this is just a repeat, okay? Case-shiller home prices, the home prices are projected to go up for a few more years. Record low existing inventory. This is shocking. So that's why, that's why I do not foresee any kind of crash or any kind of a bad correction, because real estate is about, demand, supply and demand, low supply, high demand. And housing prices will rise because of this simple metrics. Okay, so until supply of homes catch up with demand, until there are equilibrium between supply and demand, then we have a normal market. But the problem is, here's the problem. I'm using one example. I'm using Austin as an example. Look at here. The median price of Austin is already $550K. This is a metro inside Austin, okay? $550K right now already. 2 years ago, the median price is probably around $400K. 5 years ago in Austin, in this neighborhood, the median price is probably $300. The city of Austin, the properties have appreciated more than 100% in the last 2 years. This is historic. I've never seen any acceleration of home appreciation ever in history. As you see in Austin, the only other city that I see that have achieved massive appreciation is in Boise, Idaho. Boise, Idaho, and a few other places. I mean, 100% appreciation in the past 2 years. That is absolutely mind-boggling. So the question you have as an investor is the bubble gonna pop in Austin and elsewhere? My answer is I don't think so. You know why? There's one reason I can show you right now. Look at the month of inventory. There's 1 month of inventory of supply in this particular county, the city of Austin. And Austin is comprised of several counties, right? There are like 6 other counties, which I will show you momentarily. But this is the most expensive part of us, Austin, which is in Austin proper. Anyway, 1 month supply. The 6-month supply is a normal market. There's only 1 month supply. So there's only 683 listings for a county with like 400,000 people. 400,000 people, only 683 listings. This is mind-boggling record low supply, right? 1 month of inventory. You know how hard it is for inventory to catch up? It'll take years. Well, maybe several years. So city of Austin and another surrounding county, here is one of the other county, I think this is Bastrop County on the east side of Austin, like 20 minutes to the east. The price is a lot cheaper, $290K, which is a cheapest area in the Austin Metro. And Austin Metro covers a big area, right? Covers Central Texas. So $290K is the lowest median price in the suburbs of Austin. In this case, Bastrop County, I believe, only $290K. You look at month of inventory, 0.6. You know what that means? 0.6 means less than 1 month of inventory, like 2 weeks of inventory, whereas 6 months of inventory is a normal market. This means 0.6, which is 2 weeks of inventory, and there are no more supply coming in 2 more weeks from today, there are no houses to sell in this county of whatever, 200,000 people, no houses to buy. That's such a big gap in disparity between demand and supply. That is the main fundamental reason that we're not going to see a crash or a correction or a bubble. Because whenever there are more demand than supply, right, and housing prices will continue to increase. For people to think, oh, the Austin market is at the top of the market. No, it's not at the top. By looking at the supply versus demand, as you can see right clearly on this screen. So with that said, I mean, for investors, it's kind of hard to cash flow. Maybe $290K you may cash flow if you can get rent for $2,000, but only, as an investor, you should buy in Austin 2, 3, 4, 5 years ago, right? You will make tons of money, but now it's too late for most people. But $290K, anything under $300K, the rent is rising, even in this area. So if you can find inventory available to buy as an investor, this price point would be ideal. Okay, but it's very, very hard to find inventory. Okay, San Antonio, similarly, the month in April 2021, the month of inventory available is only 1.2%, right? So there's a tremendous lack of supply in the San Antonio market, tremendous demand. So San Antonio, which is only 1 hour below Austin, where the median price is only average sales price is only $316. So price points are a lot lower in Austin, in San Antonio than Austin. So I believe there's a tremendous appreciation market potential in San Antonio, because most people, they're priced out of Austin, they're coming down to San Antonio to buy and to rent. So I see a tremendous uptick in the San Antonio market, but right now the price point for new construction is only like $200K, $220K, very, very low price relative to what's going on in the Central Texas market, including Austin, which is very close by. So the value is here, right in San Antonio, and the rent is like 1550. So your cash flow 25% down quite nicely. Okay, so I'm not going to discuss too much. All this double-digit appreciation all over Central Texas and all over the country, really. Okay. All right, so single-family housing units, these past 10 years is, it's just so few houses are being built in the past 10 years. That is why we're seeing such a low inventory. According to Lawrence Yun, the chief economist of National Association of Realtors, he said recently, this is not a bubble. It is simply lack of supply. Oh my goodness. Another person, Sam Cater, vice president and chief economist at Freddie Mac, right? The lending institution. The main driver of the housing shortfall has been the long-term decline in the construction of single-family homes. That decline has resulted in a decrease in the supply of entry-level single-family homes or starter homes. Look at this. The current inventory nationwide right now, I believe, I could be wrong, is around 1.2 million homes of homes available sale right now. According to this news article from the Motley Fool, based on the Yahoo website, it is determined that the U.S. housing market is 3.8 million homes required to meet the demand for this year. We have 1.2 available inventory homes nationwide. We need 3.8. You see the massive gap between supply and demand. This is monumental, historical, massive. So this is amazing. And new home construction, because of rising lumber prices, the new construction are not keeping up with the demand. So many new builders are frantically trying to build, but here's the problem. There's a short supply of lots to build on everywhere. Skyrocketing lumber prices are increasing the home new builds astronomically. Cost of materials has rising, and the supply chain is broken. Inventory is extremely low, historical low. So because of that reason and the rising US population, how can anybody will see a crash, correction, or bubble? No. So economics 101, when demand exceeds supply, housing will continue to rise and housing will continue. If there was only 1 month supply in a typical market throughout the US, and it requires 6 months for balanced market, right? And with the builders not building because of the lumber supply issues, and they are pausing construction, believe it or not, it'll take several years for supply to catch up with demand. Several years, who knows how many, 2, 3, 4 years. So I see continual uptick in home prices with very low risk. So as long as the interest rate stays low, there are talk about interest rate getting higher slightly, but still at a historical rate. So, and the sellers are still not selling. As we move into the spring and summer right now, the sellers are not. I mean, there's a slowdown in home sales. The slowdown of the home sale came as a result of a buyer fatigue. I call it buyer's fatigue. Not only that, there are another three reasons for the slowdown in sales this summer 2021, because those three are many potential buyers are priced out of the market. Too expensive. They can't afford it. Number one. Number two, they are freaked out. Many buyers are freaked out. Remember, freaked out, they'll give up. They give up. They're freaked out. They can't handle the stress of doing multiple offers and not getting any acceptance. They give up. Okay, they temporarily will continue to be a renter. And finally, the third situation is the buyers are tapped out. Tapped out. That means they tap out means financially they can't afford it anymore because of rising home prices and stress wise, mental health wise, they cannot handle the frustration and the challenge of trying to buy a home because there's so much demand and competing against so many people. That's what's going on out there. That's why there's a slowdown in sale, not because the real estate market is doing bad. All right, let's go on. Racket City, as we know, Huntsville is up and coming little market nobody knows about except me. I said earlier, who is the most important space entrepreneur? Jeff Bezos, Elon Musk, and Richard Branson. They are into commercial space exploration. Okay, soon, very, very soon, within this coming year or so, there will be a tourist that's going into space. I know you have to pay $500,000 or more to go in a safe space balloon, but yep, Space Coast, Palm Bay, Florida will be the area that where all the rockets and Cape Canaveral Space Kennedy Center is all located in the Palm Bay area. So that is that mini tech hub market is the one of the areas of real estate growth. Okay, just so you know, not many people knows about it except me and you. All right, military space force. By the way, I spent 20 years in the U.S. Army, retired. So Space Force is another military branch which is created, no different than Army, Navy, Air Force, Marine. They have created another Space Force. The Space Force will be headquartered in a Patrick Air Force Base in Palm Bay. Another reason why is a good real estate market, and Space Force with another secondary headquarters in Huntsville, Alabama. Okay, Space Force is a very big thing. The military is and the government are expanding into space, and the location to buy investment properties is in Alabama, Huntsville, and Palm Bay. FYI. All right, so okay, let me see what else. Let me see what else. Let me see what time is it. 11:12. Okay, we got 15 more minutes before we do a Q&A. Okay, how's that sound? You guys are still with me? Hopefully you are. Okay, Metropolitan MSA 2021 ranking. You know, MSA is like this research website analyzed the 40 areas, metro markets in the U.S. and they rank based on various economic metrics, and they decide the top ranking. So as you can see, Utah, Florida, Texas, Utah, North Carolina, Idaho, Arizona, Tennessee, Utah, Alabama. Right? So mostly in the south and southeast. If it is in the west, that means the housing already too high. So the areas that I would like you to target are Central Texas, Austin area, San Antonio, Palm Bay, as I said earlier, 1 hour east of Orlando, high growth, and then Raleigh, North Carolina, which is the home of the Research Triangle Park. Very good opportunity for break-even cash flow, high appreciation in Raleigh, North Carolina right now. Is a short window of opportunity. Not Boise, not Phoenix, not Nashville, not Utah, and of course Huntsville, Alabama. So area I would like you to target because of low price cash flow situation, new construction, Huntsville, Alabama, Austin, Texas, Palm Bay. Okay, out of these top 10. So I said earlier, just because you've been hearing on the news, yeah, Boise's doing well, Phoenix doing well, Washington State doing well. No, not true at all. The prices, the medium home prices in those areas are too high relative to the rent that you're going to collect. And for that reason, it's not a good purchase decision to buy out there in the West, except Las Vegas, because the Las Vegas, the rent upsurge has really accelerated, and you can buy a $320,000 single family home in Las Vegas and it rents for $2,200. That means, as I crunched the numbers, with 20% down, you couldn't cash flow even in Las Vegas, which is a mere 1 hour flight from Bay Area to there. So a hop, skip, and a jump, you can cash flow in Las Vegas, but not in California, not anywhere in California you should buy. The future ain't what it used to be, Yogi Berra said, and people buy in the lowest tax states, which is Texas and Florida. Sunbelt rising, Austin, Tampa, Jacksonville, many in Florida, right? And all right, and of course, Research Triangle Park, which is going through a beginning of a boom. Raleigh, North Carolina, in the surrounding area. Apple is moving there. So this is a Austin 2.0. Just keep that in mind. What transpired, the skyrocketing appreciation in Austin came as a result of Apple building a campus 2 years ago in Austin. And then subsequent to the pandemic and the high-tech boom in Austin, prices have skyrocketed in the past 12 months, 30 to 50% in many areas in Austin. So the same trends are happening in Raleigh, North Carolina. But if you want to buy in Raleigh, North Carolina, you have only a 3-month window, maybe 6-month window. The price point you should buy within 15-mile radius of the Research Triangle Park. And the single family homes in this area are anywhere from $300,000 to $400,000 single family home built in the past few years. Relative newer resales, they rent for like $2,000. The best you can hope for is a break-even cash flow at 25% down payment. So this is a equity play. This is not necessarily a cash flow strategy, but hey, it's still good time to pull the trigger and all that. Okay, so this chart shows the what? Shows Texas. Yeah, Texas is the ninth largest economy in the world. For all the reasons, I'm not going to go over all the details. You can review this on your own later on. So Texas is showing some very great projection for the future. America's largest economic engine, Texas, the world's ninth largest economy, whereas California is the world's 6th largest economy. So Texas is right behind California in terms of the largest economy in the world. So one more thing is the Austin-San Antonio corridor is a mega region. What does that mean? That means in next 10 years, as you can see on the chart, by the year 2030, this mega region will grow to 6 to 7 million people from the current 4.5 million people. Astronomical population growth. Clearly, the number of supply of homes and a new construction could be built in the next 10 years will no way near enough to accommodate to 6 to 7 million people total population in 10 years from now, which is mind-boggling. So I believe the demand of homes will far exceed supply in the Austin-San Antonio corridor mega region for years to come. Therefore, I do not see crash, bubble, correction in the Central Texas market anytime soon, unless the interest rate will go skyrocket for whatever reason, and unless the economy has gone through some very unique crisis, which we have not foreseen. So absent a astronomical economic collapse by U.S. or interest rate skyrocketing to the stratosphere, absent these two scenario, I expect the Texas market will continue to increase in prices. So the best time to pull the trigger is not tomorrow, not next week, not next month, not next decade. The price to pull the trigger, the time to pull the trigger is now, today. So the typical single family home, casual properties, in the Central Texas area above Austin would be, 1 hour above Austin. You can buy $181,000 new construction, the rent for $1,525. You see the numbers, you still can get cash flow, even though the property tax is relatively high, but still, it's all about the cash flow. It's all about the bottom number. So still good return, but the prices is rising in the suburbs of Austin, obviously. So another example, 40 minutes above Austin, you can still see a decent price point, $209,000 new construction, but it's going to increase, significantly in the next few months. That's how it is. But the numbers right now still somewhat make sense if you can find the inventory available, which is very, very rare because builders are not building because, as I said earlier, right, construction price, lumber has increased so dramatically. The builders are pausing construction. They're not building anymore. They're pausing until the price of lumber comes down. So it will exacerbate the inventory of homes available. So, yep, okay. I know New Braunfels is an hour below Austin and 30 minutes above San Antonio, having very good price point, $225K as of today. These 225K could increase to 250 to 300K in about 6 months. Who knows, right? That's how it is. Acceleration or appreciation based on high demand and low supply. So you can still cash flow at the rent range of 1490 to 1525. You do the numbers. And then of course, San Antonio is the best value. New construction is only 230K. There are still inventories available for investor, but in a few months, the investors could be closed. The builder may decide not to sell to investors because of rising demand and tremendous appreciation potential. So the window to pull the trigger on new construction in San Antonio, in my estimation, is only maybe 6 months. In 6 months, all these new builds inventory will be gone, will be scooped up by buyers from Austin and from California, from New York, from all over the country, gonna converge into Austin, and they're gonna wipe out any inventories completely off the map. So you're very lucky right now. The builders are allowing investors to buy as of today. May not be tomorrow, may not be 2 months from now, but we don't know. But because Austin, that's what's happening in Austin, Texas, right? The builders they close. The investors cannot buy new builds in Austin anymore. In Austin, if you want to buy new builds, you have to be on a wait list. You have to enter into the lottery just to find a new build to buy. Oh, by the way, have you not seen? There's a new community in San Diego, new construction community. Forgot the name of it. They have like the first 200 units of available homes to buy. The lots for 600,000 to 1.3 million. The 200 lots that are phase one. You know how many potential buyers? 10,000. 10,000 potential people want to buy the first phase of this new home construction in San Diego. 200 lots, 10,000 inquiries. And then they have a total of 1,800 units, priced from 600K to 1.3 million. I believe that 1,800 units in San Diego, the new construction, there might be, I'm just guessing, there might be 30,000 inquiries to buy those 1,800 lots in San Diego. So what I'm trying to say is any new build located anywhere in the country, especially in Florida and Texas, North Carolina, any kind of new builds, if the builder allow investors, which is many builders does not allow investors to buy, new builds because they only want owner-occupied buyers. So what I'm trying to say is there's a massive amount of demand from investors and owner-occupied buyers to buy new construction houses in any and all markets. So you are competing against so many people. So if you can find a builder that you can pull the trigger, you are lucky. You can win the lottery. Okay? All right. Okay, again, let me see what time. We're getting close. 5 more minutes. Okay, let me finish up. No supply, no home supply available for several years. Very few homes. So America has become the renter's nation. Affluent people are renting because they can't buy for many, many reasons. Okay, so renting is out of necessity. So few homes to buy. So many people want to buy them. The affordability gap is increasing. The prices are rising. Many people making $80,000 to $100,000 all over the country are relegated to renting. Every homes that I've seen to close escrow in the past couple of years in Florida and Texas, those single-family homes, new construction, there are 30 to 50 rental applications per house. There are bidding war from renters that want to rent your nice house, the new construction especially house. Could be, may not even need to be new construction, could be any kind of good houses. Even in the Midwest, there are multiple bidding wars for renters who want to rent your house. Do you understand the words coming out of my mouth? This is this quote is come from the movie Rush Hour by Jackie Chan and Chris Tucker. Do you understand the word out of my mouth? I mean, you as a potential landlord, when you buy any kind of houses in good areas, the cash flow, you're gonna have renters knocking down your door. Please, I'm a renter. I need a house to rent. There's not enough houses to rent. That is absolutely true everywhere in the country. So is it a good time to become an investor these days? Of course, yes. Because all you need is renter to pay your rent and then some for a long time to come. This is the greatest wealth building strategy in history. Just make the renter will make you rich. That's the bottom line. Oh my goodness. Empty nesters are downsizing. They need to rent. Rising home prices push households to rent. Oh, I mean, okay, this is very obvious, okay? Oh boy, anything else? Oh, nothing else. I'm done. Oh my gosh, this is amazing. I'm right on time right now. It's 11:28. So for the remaining 30 minutes or so, we can do some, all of you still with me? Go get a second cup of coffee perhaps. Woo. So feel free, open up, just tell me your first name. You don't have to identify yourself. So for the sake of confidentiality and privacy and all that, you know, nobody can know who you are except you and I. All right, so feel free to ask me any questions. I'll be any kind of questions. I will be transparent. I could be honest with my answer. Feel free to do it because this is your time. This is your world. This is your financial freedom goals. I'm not saying you can do it through me. I'm not saying that. I'm giving you some high-level education. You know, understand what's going on. The things I've taught you is real life applications. I lived through this. Okay, enough for me saying. I need to hear from you. Who are you, by the way? Are you Melissa or are you Cassandra?
Cassandra.
Cassandra. Okay.
Thank you so much for all of this. This was definitely very helpful. Looking forward to looking back at the recording. I guess I have a question. So I'm originally from the Bay Area. My family's still out there, but I've actually temporarily relocated for these past couple months in Orlando.